Today is our topic, which is a theoretical topic called accounting concepts. Today we will discuss this theoretical chapter, which consists of number of accounting concepts. Remember one thing, accounting, the baseline for accounting is international accounting standards, and international accounting standards based on some principles or some concepts. These concepts are known as accounting concepts. Got my point? The first accounting concept is duality. Duality means double entry. As we all hear in our lives that Newton law, everything, is a dual effect, or it says that every action do have an equal and opposite reaction. So duality is something similar to that concept. Means in easy words, every debit must do have equal credits. Like we learned accounting entries, we saw that if bank is debited, some other account must be credited. If two debits, there should be some credit which must be equal to debit. So debits is equals to credits. Debits equals to credit. This is accounting concept behind it. And this concept is known as duality. Duality means each debit must do have equal and opposite credits. Got my point? This is the first concept, which is duality. The second accounting concept is the second accounting concept is business entity. Business entity means that owner is separate entity from his business. That's why we are keeping separate account of capital in our books. Although business owned by owner, business owned by owner, but because of separate entity concept, we are treating owner as a separate entity, and we are maintaining a separate account which is called capital account. The maintenance of separate capital account, the concept behind it is called business entity concept. यानी घर अलग, business अलग. Owner is separate from his business. The third accounting concept is very easy. This is called money measurement concept. Money measurement concept means that we will take only those transactions which involves cash or bank, yani which we can measure in form of money. Yani accounting will be only for those transactions which are in form of cash, which are monetary in nature. Non-monetary items we are not going to deal with while doing accounting. As we did a lot of questions like depreciation, bad debts, journal accounting entries, always we are making entries with some amount in dollar, amount in pounds, amount in rupees. Yani there should be some money measurement involved. Yani accounting can be done only when there is money involved. Yani only the transaction which we can consider while doing accounting entries, the transactions must be in form of cash. So this is the third accounting concept. The fourth accounting concept is historical cost. As we all knows that assets, the non-current assets, when we bought non-current assets, we are debiting them, right? The non-current assets or assets increases on debit side. Am I right? So asset increases on debit side at what amount? At the amount in which we bought it. If I am buying an asset for $100,000, I should record it at $100,000. I should record it at $100,000. Whatever its market value, the market value can be upwards or downwards. Khalli walli, ignore. If we are following historical cost accounting, we will keep our all assets at their historical cost. Historical cost means original cost. Original cost means the cost at which you bought it. You will keep the asset on its real cost if you are following historical cost accounting. So this was another concept. The next concept is realization. Realization means accounting is based on accounting is based on realities. If something is not real, we will not take it in accounts. For example, if I tell someone, okay, I am selling you goods, but this is my goods, I will take it back from you after some time. So this is not an accounting. This is not a sales. Why? Because it's not realistic transaction that you are selling. After some times you are going to take it back. So what type of sale it is? In order to make a sale, the title, the ownership on goods must be transferred to the buyer, and buyer can do anything with that goods. You have no rights left on that goods. But if you are selling by saying this is mine, huh? Just keep it. I want to just book my sale revenue. After some time, I will take it back. So it's not a realistic transaction. It's just a play. It's like playing games. And accounting cannot entertain this type of transactions. Why? Because it's against the concept of realization. Then we have a concept which is called consistency. This concept we already discussed while we were doing depreciation. What is consistency? In our easy words, we can say if we are following one policy, we should continue that policy. For example, if we select reducing balance method for one class of assets, the same method should be continued for all the asset under the same class. We cannot do like that. One asset reducing balance, another asset is straight line, third asset some other method. No, you must be consistent. You must be consistent. So your business financials gives true and fair view. So consistency is to follow one method and continue it. You cannot do that this year straight line method, next year reducing balance method, next year again straight line. What is this? You should be consistent in your accounting. You should follow one method and continue it because the concept behind it is called consistency. Next thing is materiality. Material amount. Material amount is the amount which can affect your decisions. For example, if I ask, like you guys are students, and if you have $100, oh my God, you are a student and you have $100, and if you lost this $100, what will happens to you? What your mama will do with you? it will be very big problem. You lost $100? Oh my God. But what about the company called Aramco, which is a giant of KSA petrol company? Or what if Al Marai milk? Or what if Shell? What if PSO lost $100? For them, $100 is just like peanuts. Peanuts, yani ignorable amounts. For these big companies, $100 are nothing. But for you, for a small bakala shop, small grocery shop, $100 is a material amount. Yani, with this example, we can say materiality can be varies from business to business, size of business to business. If a business is a giant, the ignorable amounts and immaterial amounts, ignorable amounts might be mm, big, big amounts. And if it is a small business, immaterial amounts, ignorable amounts can be very small amounts. We can say for students or for a small bakala shop, $10 might be immaterial. More than $10 amount is a material amount. So materiality is ignorability. Immaterial amount means the amount in which the mistakes or the fraud or the theft you can ignore. And material amount is not ignorable amounts. You cannot ignore them. You must focus on them because material amount can change the decision of company. Got my point? The next concept is matching concept. This concept we usually discuss when we are discussing depreciation, because depreciation is coming or driving from this concept. What is matching concept? Matching concept is your income must be matched against your expenses. For example, if we do have an asset and we are utilizing this asset is giving us income, this asset is bringing economic benefits to us. But what is the problem? The problem is the wear and tear. This asset is depreciating by year. The performance of that asset is reducing over the period of use. So this wear and tear, you should record every time because you are utilizing it. You are earning money from that asset. So you must record the wear and tear right now, not at the end of the life of that asset. So this is matching concept that incomes should not be overstated and expenses must not be understated. Your income must be matched against the expenses you incurred. That's the matching concept, and depreciation drives from that concept. Then we have a prudence concept. There is a saying some people say is, if expense is estimated, you should record it, you should take it into accounts. So profit cannot be overstated. And income you should not record until it's realized, until it's not came in your hands. Expense should not be understated. Profit income cannot be overstated. Prudence concept is खर्चा लगे एस्टिमेट हो तो रिकॉर्ड करो. इनकम जब तक हाथ में ना आए, रियलाइज ना हो, रिकॉर्ड ना करो. एक्सपेंस should be recorded when it's expected. The best example of that is provision for bad debts. Provision of bad debt is not an actual written off. That guy, the customer is not yet run away, but because of prudence accounting, prudence concept, if we have a doubt that this guy will run away, we will record, we should record the provision, we should record the expense. and this is in line with prudence concept. So we should be aware of what is prudence. Prudence is to record expense when it's estimated, and you should not record any income until it's realized, until you got it. Income must be recorded when it comes to your pocket, when it's realized properly. That's the concept of prudence. Okay, the next concept is going concern. Going concern is going concern is that the business which we are in will continue in next 12 months or no. Like as an accountant or as an accountant, we do have reports, and in those reports, because of those reports, we can judge that how the business is going to perform. If business do have continued losses, history of losses, if business do have history of losses, we can say since 5 years this business is making loss, owner's equity is very less, the liabilities are very high. What is this? This is a clear cut reflection that this business is going to be closed down at any time because they don't have profits, they don't have equity, and the loans are too much, and they are suffering with finance cost, yani interest expenses on loan. Yani the situation of business is worse, means this business is going to be closed down in foreseeable future, in next 12 months. Foreseeable future means next 12 months. If that is the case, we can say this business is not a going concern. Not a going concern means this business is to about to be closed within next 12 months, within foreseeable future. But if we can say there is a business which has good profits, owner equity is good, owner is skillful, owner is nice, employees are happy, work is going on, sales is growing, so it's a good business. And by looking at this scenario, we can say this is a going concern. Going concern means it's not struggling, it's not have any problem, and this business have no possibilities to be shut down in next 12 months. So it's a going concern. Going concern means it will continue. Not a going concern means it will not continue in next 12 months. Got my point? The next concept is substance over form. There is something called legality, and there is something called accounting concepts. Legality means that legal provisions. Law says that if you own an asset, you should record it. Accounting says if you are using an asset, you should record it. There's a conflict. Law is saying legal ownership. Accounting is saying economic benefits. There's a conflict between law and accounts. Legality is something different, accounting is something different. So substance over form means that sometimes accounting concepts are not in line or not in accordance with, not in line or not in accordance with legalities. So it's okay. In order to provide true and fair view, you should follow the accounting instead of following the legalities. So if you have an asset and you are using it, taking economic benefits from that asset, you should record that asset in your books. Although you don't own it, you should record it. This is accounting and this is called substance over form. This is the end of this particular chapter, which is accounting concepts, basic of accounting. Okay, see you.